When you're in the process of buying a home, there are 4 different types of insurance that you're going to come across. Some that you may want but not need, some that you may need but not want, and others that you may or may not need depending on a variety of circumstances. And for Canadians, this can be somewhat confusing, especially since it's not all that uncommon for people to mistake them amongst each other. So let's go through them. The first is mortgage default insurance. Anytime you're buying a home in Canada and you're putting less than a 20% down payment, it is a legal requirement that your mortgage be default insured. Essentially, mortgage default insurance is something that you pay but goes to protect the lender in the event that you default and can't make your payments anymore. And the general principle behind this is that the Canadian economy will be stronger as a whole, because if something comes and wipes out a bunch of home buyers, all of these banks will not fail because there's insurance in place to protect the lender in the event of mass default, or really any default. That's at least the theory. Now, you might also know mortgage default insurance as CMHC fees, because for the longest time, CMHC was the most dominant player in the mortgage default insurance space. But there is also Sagen and Canada Guarantee. A few years ago, CMHC controlled over 70% of the mortgage default insurance market in Canada, but due almost entirely to mismanagement, fell down to somewhere in the 30% range now. So they're not nearly as dominant as they used to be, but they still remain the Kleenex brand for a lot of Canadians as far as the mortgage default insurance market is concerned. So how much is Sagen, Canada Guarantee, or CMHC going to cost you? Well, they all charge the same fee, and over the years it's been known to change, but it's always been based on the size of your down payment. As of right now, if you're putting 5% down, expect to pay 4% of the value of your mortgage as your insurance premium. If you pay 10%, expect to pay 3.1%. If you get to 15%, expect to pay 2.8%. And of course, like I said before, if you can get to 20% down, you will not have to pay the mortgage default insurance. But there is a catch. In 2016, the government changed some of the regulations around what could or could not be default insured. One of the consequences of those changes was that if you had a conventional loan, something where you put 20% or more, you could no longer qualify for portfolio insurance. And what that meant was that if you put 20% down, yes, you got to save out on the fees, but you were now considered a higher risk because you were no longer insured in the same way to a lot of these mortgage lenders. And what happens when lenders have additional risk? Well, they increase the rate and the cost of that mortgage to offset that risk. Now, over the years, the math on this has fluctuated a bit. Sometimes the difference in the two rates is so large that it actually makes sense to put less than 20% down, pay the CMHC fee, and enjoy the interest rate savings that you're going to get from having the lower rate. And other times, the rates between 20% and lower than 20% are so close that you might as well just pay the 20% if you have the funds available to you and enjoy the lower payments. If you're curious and you want more information on how the different down payments affect different things, which is beyond the scope of this video, make sure you check out a video I recorded a couple years ago. I'll make sure to put the link in the description of this video that may answer a lot of those questions for you. The second type of insurance that you're going to come across is known as home insurance, also commonly known as fire and flood insurance. Now, this is insurance that you're going to need as part of your mortgage transaction, but it's also insurance that you're going to want. After all, the only thing worse than a mortgage on a home is a mortgage on a pile of ash. Now, one of the things that I'm asked all the time is, Conrad, where should I get my home insurance from? And the truth is if you go and you get 10 different quotes, they're all going to roughly end up being the same anyway. I mean, there might be small variations, but very, very rarely does it matter materially. So what I always tell people is that to go and to get a quote from the place that provides their car insurance, and maybe get a second quote just to make sure they actually do line up and the cost is what you expect it to be. Because if you can get your home insurance from the same place that provides your car insurance, then all of your insurance is in the same place, and it's going to be a lot easier for you to track in the long run. When you do go get your insurance though, make sure you're bringing 2 things. Make sure that you're bringing your MLS listing for the place that you're buying, because they're going to ask you a lot of information about the property within which they're insuring in order to be able to quote you. And they also need the address for the mortgage lender so that they can properly update the loss payable. This is who gets paid in the event of loss. So if your house comes burning down to the ground in a very, very unfortunate event, who do they have to pay? In this case, it would have to be the mortgage lender to make sure that everything is properly covered. The third type of insurance that you're going to come across is called mortgage life insurance, and it's meant to protect you and your loved ones in the event of death, critical illness, or disability. So in the event of death, you're not leaving your loved one with this massive mortgage. Life insurance may come in and pay it all off. Or in the event that you're critically ill or disabled and no longer able to make the payments on your own, insurance may step in and make those payments for you for a set period of time. Now, there are so many pros and cons when it comes to this type of insurance that I could literally make a whole video just on that alone, and I intend to. So if by the time you're watching this particular video and that video is made, I will make sure to link it in the description below. Some people absolutely swear by this type of insurance, saying that if you don't get it, you're a fool, and others say that it's the worst possible insurance that you could ever get. And I'm sure that the truth is probably somewhere in the middle. What I do know is that the premiums you'll pay to get mortgage life insurance can vary quite wildly. So it never hurts to get a quote because you're not required to go with it. Who knows? Maybe the insurance premiums will be low enough that it makes sense to add. What I will say though is I have personally seen what happens when people aren't properly covered, and it is absolutely devastating. So whatever insurance you do decide to go with, make sure you have the insurance necessary to protect you and your loved ones. The fourth type of insurance that you're going to hear about, likely for the first time ever, is called title insurance. It is one of the most unknown and yet one of the most standard types of insurance when purchasing a home. In fact, it's so standard that no matter which mortgage lender that you get, they're going to make it a legal requirement that you have this title insurance in place. It's a one-time fee somewhere between $300 and $900 depending on the price of the home that you're buying, and it's built into the closing cost. So that means you don't have to worry about whether title insurance is in place or not. It will be the responsibility of the lawyer to make sure that that has been arranged. Title insurance is meant to protect you against title deficiencies, like making sure that you don't have easements or liens or judgments against your property that you aren't aware of, making sure that the records aren't flawed or that there isn't restrictive covenants. Title insurance is also meant to protect you against cases of fraud, like in the event that someone sells your house to another person without you even being aware of. And believe it or not, that happens way more frequently than you would think.